This is a familiar topic. We discussed it a variety of times in different
Right.
ways, and it's just driving home. I think the reason it's relevant again is because statistics came out again on inflation. But in addition to that, we all have a bias towards wanting information to be received the way it benefits us. And we have enough buyers out there that kind of still give us that I'm going to wait for the turn. I'm not going to commit and jump in. And
Yeah.
I think this is partly for them because we want to see them win. We want to see them get a house. Um, and there's really not a lot of indications that anything is shifting soon. And if they saved cash to buy a house, that cash is going to become worth less over time. And that's disappointing. So,
Right.
where do you risk that inflation won't be a long-term issue and that your cash will maintain its purchasing power?
Right.
Or, just dive into the real estate market and like a lot of people are predicting, hope it doesn't shift.
Yeah. Yeah. Okay, well, let's get into it. This is from housingwire.com, another industry resource talking about mortgages in particular, but overall the housing market here in the United States and sometimes elsewhere. So this is entitled "Why Owning a Home is the Best Hedge Against Inflation," and this is dated March 10th. So let's get into it. On Thursday, the Bureau of Labor Statistics reported the same trend that all Americans have seen lately. The inflation rate of growth is rampant and doesn't show any sign of easing up due to the Russian invasion of Ukraine. The Consumer Price Index for all urban consumers increased 0.8% in February on a seasonally adjusted basis after rising 0.6% in January. Over the last 12 months, the all-time index increased 7.9% before seasonal adjustment. And Darren, I count on you to kind of nuzzle this all down into beyond the technical terms here. So help us all out.
Sure. Yeah.
As you can see below, the CPI inflation rate of growth chart looks like many economic charts during this COVID-19 recovery and expansion. A parabolic type move deviated from recent historical norms. Our economy is running hot and the labor market is getting hotter. During the COVID-19 recovery phase, I predicted that job openings would break over 10 million. This week, we just broke to an all-time high in job openings with nearly 11.3 million. What does that mean? Wage growth is going to kick up. Early in 2021, I told the Washington Post that rental inflation was about to take off and will take the consumer price index up faster and last longer. For me, it's always about demographics equal demand. Wages are rising, which means rent is about to get higher. You want to say anything there?
Across the board, man.
Yeah.
I think the majority of people would like to have people earn a living wage, make things more affordable. In LA, things are really pushed, and housing is one of the biggest costs of living for sure in Los Angeles.
Right.
But yes, in addition to house prices will be stable and it's the best place to invest your money, rent will rise tremendously because of the cost of labor, because of the cost of doing business. Now, the city of Los Angeles is trying to say, no, all these costs are going to rise, but landlords, you can't increase prices. And, in my opinion, that's kind of shitty. I don't want that ratio to shift, but how can you not allow them to shift that burden that's overall? I mean, people are making more money who are renters, maybe not all of them, but a good amount of them. I always feel make sure that money goes to those that really need it. In addition to that, obviously, inflation is going to continue to have pressure towards an upward trend because of the cost of transportation now. And that's going to be huge. That's going to affect everything with the cost of gas rising. So, tough time to be a renter still going forward. So it makes housing even look more attractive.
Well, that's what this article, really is keying off of shelter inflation, but and I think it might touch on the gas issue, but I think that's a whole other level you just hit. So, shelter inflation, The most significant component of CPI is making its big push is people need to live somewhere, and that shelter cost is a priority over most things. Rent inflation on a year-over-year basis has been extreme in certain cities, averaging over double digits. And just so you guys know, I just sent out this link. If you want to look at all these great charts, please do later. Now, we can see that being a renter has been problematic because rent inflation is taking off, gas prices are taking off, and even the wages are up. The monthly items consumers spend money on have gone up in the most prominent fashion in recent history. In most cases, seeing this type of rental inflation can motivate consumers to buy a home because renting a home isn't as cheap as an option anymore. However, if you're a young renter and looking to buy a house a few years away, this makes savings for a down payment much more of a problem. On top of all that, since inventory is at all-time lows, it's been harder and harder for first-time home buyers to win some bids because they don't have more money to bring into the bidding process. As always, the marginal home buyer gets hit with higher rates and higher in home prices. Now, single household renters are paying more for their shelter, making the home buying process more challenging financially. What can Americans do to hedge themselves against this? In reality, being a homeowner over the past decade has set consumers up nicely during this burst of inflation. How is that? Housing is the cost of shelter to your capacity to own the debt. It's not an investment. This has been my line for a decade now. Shelter cost is the primary driver of why you might want to own a home. The benefit of being a homeowner is that with a 30-year fixed mortgage rate, that mortgage payment is fixed for the life of the loan. Yes, your property tax or insurance might go up, but the mortgage payment is generally fixed. What has happened over the years is that American homeowners have refinanced time and time again to where their shelter costs got lower and lower as their wages rose over time. We can see this in the data. It has never looked better in history with the recent refi boom we saw during the COVID-19 recovery, since mortgage debt is the most significant consumer debt we have in America. This would imply that household debt payments are at deficient levels as well, which they are, as we can see below. All right. In the last 10 years, the big difference is that we made American mortgage debt great again by making it dull. While wages rise, long-term fixed debt cost stays the same. It doesn't get any better than that. So how does that make being a homeowner a hedge against inflation? As the cost of living rises, wage growth has to match it, especially in a very tight labor market. Companies can no longer afford not to increase wages to lure employees to work and retain workers. Wages are going up. That what doesn't go up? Your mortgage payment as a homeowner. So you can benefit from increasing wages while the most considerable payment stays the same. Why do I keep stressing that the homeownership benefit is a fixed low debt cost versus rising wages? While renters feel stressed about rental inflation and higher gas prices, homeowners never need to worry about their sub minus 3% mortgage rate increasing versus the 7.9 inflation rate of growth. Some people who are surprised by all this inflation we have had over the last year are now asking how the U.S. economy can keep pushing along. Not every household is the same. If you're a renter, your rents have gone up, and that takes away from your disposable income and makes it harder to save for down payment as well. If you're a homeowner, the inflation cost isn't as bad. Since you are benefiting from rising wages, that offsets the cost of living, and you're safe in your home with that fixed product. This is great for a homeowner, but it contributes to a larger problem. The homeowner is doing a little too well and might have no motivation to move. Why would anyone want to give up a sub minus 3% mortgage rate and such a solid positive cash flow unless they're buying something that will make their cost much cheaper? People move all the time for many different reasons. However, let's be realistic here. Housing inventory has been falling since 2014, and 2022 isn't looking any better. Also, go ahead.
On that note, Joe, I'll just drop in the other article that I was reading.
Yeah,
we're not reading today, but it's a crazy figure. So housing inventory from 2020 to 2021 went down 20% year over year, and then housing inventory 21 to 22 has gone down another 25%. It's huge. The inventory is just continuing to deplete.
right.
every week we get on and we talk about goods and bads, and we're always looking for what's the ratio of is there an inventory increase? Are there more actives than solds? And
Right.
it's really not looking any better.
Well, this is funny because we'll have an example later on when we go to seller wins and buyer wins. Okay, so I'll continue. Also, investors that have bought homes for rental yield are enjoying the fact that wages are rising because it gives them a reason to raise the rent. Right, Darren? In a low interest rate environment, rental yield is a good source of income. We haven't had to deal with high inflation levels for many decades, and back in the late 1970s, mortgage rates were a lot higher. So it's not an apples to apples comparison anymore. This is a brand new ball game with how beneficial it has been to be a homeowner in America. It's not great news if you're worried about inventory getting low, as I am. I often make fun of my housing crash addict friends who have been wrong for a decade. However, now I tell them you're implying educated homeowners who have excellent cash flow will, for some reason, sell their homes at a 40 to 50 or 60% discount just to rent a home at a higher cost than what would have been the case for many years. Human beings don't operate that way. However, there is a downside to homeowners having such good financials. They don't have a reason to give up a good thing. This is just another reason I keep saying this is the unhealthiest housing market post 2010. As you can see above, with the FICO scores of homeowners, their cash flow looks great. And against this burst of inflation, owning a home is a nice hedge. My concern has always been with inventory going lower and lower in the years 2020 to 2024. Currently, with homeowners looking so good on paper, we have entered uncharted territory where mortgage rates for current owners are at the lowest levels ever recorded in history. Inventory levels are at the lowest levels ever, and now the cost of living from a rise in inflation has taken off in an extreme way. The biggest problem I see here is that this can make the housing inventory situation much worse, as homeowners now have even more incentive to never leave their homes. There you go. Put a positive spin on that one.
Well, yes, they don't have incentives. Yeah, we're relying on more homes being built, infill happening, and it's in process. It is happening,
Right.
Not at a fast enough rate.
Mm-hmm.
And I do think people in our case are just leaving the city. This is why secondary markets have exploded in the last 2 years.
Right.
Prices have gone up in adjacent markets in conjunction with the fact that a lot more people can work from home. The timing of that was the perfect formula for those secondary market prices to rise,
right,
in a big way.
Right.
So, gosh, man, I mean, I have this thought in my head that I've always had that I don't know that it'll ever happen. And that is, Joe, you there?
Yeah, keep going.
Okay,
I'll figure it out.
All right. So I have this thought, and I don't know. I've never heard the rumblings. It's a unique idea, and that is that there should be some disincentives for investors to own single family homes.
Mm-hmm.
They can own all the multi-units they want. That's a business. There's a whole structure there, but it really is. I feel, like those single family homes being scooped up by investors really is shifting the market even further than it probably should. And those, Joe, you there? All right. Well, I'm not sure if I'm live or not, but I'm going to keep talking in case I am.
You are, man. You are.
Okay, cool.
Okay.
So if there's, a disincentive on interest rates, if there's a disincentive on profit structure and taxation, it might disincentivize and create a little more of a first-time home buyer market on a long-term basis. I never want to do anything about past inventory where people can say, I created this whole plan and like I say, I put a lot of energy into certain investments, and for them to come in and change that seems inappropriate. But to say anything going forward is going to be structured differently, I think is the one glimpse of hope I have in the moment. So other than that, some of the prices, I will say, have risen based on expectation of inflation. So I don't know that future inflation is moving them up exponentially. It's more about the inflation that was expected to come. And we'll see where it continues to move towards.